it's a real pleasure to have you. And thanks a lot for accepting the invite and sparing the Monday evening after, I'm sure, what must have been an exciting but a little tiring day. So thank you again, and also a big thank you to everyone who has joined in. I hope to make this fun and interactive, and hope to extract as much wisdom and insights from Shreyas as I can. And of course, we'll have the Q&A session after this. So all your questions are most welcome. And who better than Shreyas to answer those questions? And I assume a lot of them would be option related. So we have the perfect man for the job. So Shreyas, again, a big welcome and thank you. So
My pleasure, Gordon. Thank you.
yeah, yeah. So with that, I'll kick off. Shreyas, I think as I as I probably mentioned to you, broadly, I think what the way we will do it is we'll do the initial 15, maybe 20, 25 minutes between the two of us, and where I have a few questions of my own to ask you, and then we will sort of after that we'll open it up for the Q&A from the audience. So that's how we will do it. So let me sort of kick off this space by asking you, Shreyas, if you could maybe give a little background about you, as a individual, as in where are you from originally, and a little bit about your childhood, and how, and leading up to how did you get introduced to the stock market. If you could just give us a broad understanding, maybe it would be really helpful to know the man behind the scenes.
Sure, Gordon. So I'm from Bangalore. I'm based out of Bangalore, and I more or less, growing up, had was a very avid gamer, you can say, and I think eventually I landed up playing the intraday trading game, which is where I am at this point of time. As far as my background, I've always been in financial circles. Finance is what I studied. I also did my master's in finance. So, in a way, within those social circles and friend circles, stocks and investing, more investing than trading, has always been a conversation. I don't know how much of an impact that really makes once you come to the market, to be very honest. But that definitely was the foundation. After my MBA, I was working as a business analyst for a tech company. So I was working with Cisco systems. I used to be in contact center. So I was a business analyst for the contact center division, which is basically when you call up a call center, the robot that you talk to, the IVR, how those calls are routed, all of that. So at the same time, I was sort of I was investing, so I was building a portfolio as such, and that's when I first sat at a trading terminal. As investing is a relatively boring thing to do, I started dabbling with trading because I started to earn money, so I had some money coming in. And it seemed like a good way to make money because I discovered what MIS is, intraday, and there you used to get leverage, so you could trade, and that's kind of how I started off trading, sort of trading cash intraday stocks. And one thing led to the other, and as I started to get more into depth with more time, really considered, okay, I have a background in finance. I'm working in something which has nothing to do with finance, and sort of transitioned. It was a slow and steady build-up thing. I think about 1.5 years from there is kind of when I decided to give it a go. Full time, really like bringing in capital, because until then I really didn't have much capital. So as it went well, then scaled up that operation a little bit, infused about 10 lakhs at the onset, and then up to 30 lakhs that very year. And after that, had a conversation, and I think like not many people talk about this, but this is very important. Had a conversation with my family and said, look, this is what I want to do. Worst case scenario, okay, I'm going to have some downtime in my career. Let's say I'm working with an MNC and I will like get back to that. But this is something I really want to give a shot. And I think that way my parents were probably the only reason that this happened, wherein they said, okay, go for it. Because you really need that like affirmation, somebody saying, okay, because it's not just that they said, okay, go for it. They looked at what I'd done. I explained to them what it is that I want to do, how it is that I make money, and how it's like a viable career thing. And then one thing led to the other. I transitioned through multiple trading styles. At that point, I was trading mostly directional. So it was mostly like debit spreads and calendars, stuff like that. Transitioned into positional credit strategies, most of them naked. Was very lucky, I guess, in the initial phase with that. And that plus expiry trading became a thing. After that, eventually, after sort of getting lucky out of some potential wipeouts, I would call it pure luck that many times I missed wiping my account. I realized that I can't keep pushing my luck, so then became mostly mostly an intraday trader, and yeah, that's the journey more or less.
Yeah. No, so one thing strikes me, Shreyas, that as you rightly said, I mean, your parents' support was a key uh, contributing factor to you becoming full time, and I mean, mm, I guess you also come from a middle class, upper middle class kind of a background where generally parents are conservative, and this stock market trading is not exactly the obvious choice. But despite that, I mean, it's a very what should I say? A very good, your parents had the trust in you, and I'm sure you were able to articulate, the way you want to do trading in a better way, in a way they could understand. So it's something which I feel very noteworthy. Generally, at least my parents, not that they discourage. I mean, even in an earlier part of my trading career, not that they discourage me, but uh, I'm sure that was not something that they would have openly encouraged. So, great. So tell me one thing, Shreyas. As you came into trading, and you, as you said, you had done a lot of things. You have your own portfolio where you do long-term investing and all that. But how did you choose options? As the within the FNO world, how did you sort of choose options, and within that, uh, did you immediately gravitate towards selling, or was it that you first went into buying, or did you both do both, or if you could help us a little bit on that?
So I would put it this way, right? So whenever you step into like a playground,
Hmm.
when you enter or you play any game,
Hmm.
firstly you need to know what are all the tools available. Like in any job you do, you kind of need to understand what are the tools available to you.
Hmm. Hmm.
So initially with equity intraday trading, the handicap I had was I was terribly short on some stocks at times.
Hmm.
Like I
Hmm.
had a huge conviction that I need to be short here. But
Hmm.
you can't carry short positions when you're doing intraday in cash equity. I'm
Hmm.
talking about the MIS in cash segment, right? So the short equity, you can't carry short positions.
Hmm.
So naturally, as you're studying more, as you're understanding more, you kind of get into okay, derivatives are the only way to hold short positions because I mean back then you used to read that in India you can't hold overnight short positions, but that's because I had no idea what derivatives were. Found out
Hmm.
about derivatives. To trade futures just didn't have the margin because my sizing at that point would have been, if I'm trading a stock, it would be 1/10 of what the future size would be.
Hmm. Hmm.
So I just couldn't do that. But if I was trading spreads, then I could sort of make that fit with what my risk reward was. So if
Hmm.
I'm trading spreads, that is viable. That's kind of how I got into options. And I didn't know, actually, contrary to what one would think, I didn't start off with selling options. I started off trading spreads mainly, and
Oh.
doing calendars. And initially, so it's been a whole journey of being a very directional person to being what now I do is highly non-directional. When my capital base was smaller, it was highly directional. In fact, I used to do intraday option buying into momentum as well. In fact, so now when people see that, okay, I only sell delta neutral triangles or partly delta biased triangles. Actually, if you see in my intraday trading playlist also, in the first 2 months there have been at least 10 days of buying options into momentum. So it transitioned from that. As my capital started to grow, I just felt that when I'm doing debit strategies or when I'm doing highly directional strategies, the rate at which my mark to market fluctuates is very high. So I just shied away from it and sort of got into a comfort zone wherein now I prefer credit strategies as far as intraday is concerned. So I think everyone goes through the journey. I don't know many people who will say that, they started off trading in a certain way and that has not changed over time.
Yeah,
So
yeah, absolutely. Yeah, I don't think there is anyone who got into something and just stuck with that forever. I mean, we it's like that Airtel advertisement, sub try karo or fir sahi chuno, So ultimately, I think you go to every type of trading, you do every type of trading, and finally you go with what suits your trading personality. I think is what I also feel. So yeah. So tell me, Shreyas, so fine, now within, I mean, do you do only intraday, or is it you do carry overnight positions also, or do you positional also?
So I would say 99% of my trading is intraday.
Hmm.
1% is once in a while when, for example, I don't like the current situation for, let us say, an intraday trade. I will
Hmm.
carry a position which is completely risk defined,
Hmm.
and it will generally not have more than 10% of my carrying margin will not be more than 10% of my overall margin. So
Okay.
that's generally how it works. And
Hmm.
that trade's max loss also will not be more than, I mean, realistic loss that I'll book on it will not be
Hmm.
more than 2%. And
Hmm.
even, for example, right now I'm carrying a double diagonal spread. The
Hmm.
max loss, like even the worst case scenario loss, is less than 4% of my margin available, my account value.
Okay.
So
Okay.
I will carry in that fashion. Like if I'm not currently interested in trading intraday, and
Hmm.
instead I would prefer right now. On Monday morning I preferred something that is positive Vega.
Hmm.
So
Hmm.
and generally my intraday trades are always short Vega. So if I'm not
Hmm.
taking an intraday trade, take a small positional trade, which
Hmm.
is fully risk defined. I do that, but majority, almost all of my trading is intraday.
Got it. I want to make a very quick digression here. You mentioned double diagonal. Okay, would you be uh, kind enough to explain us and me also what exactly is this strategy? I mean, without going into too much of specific, but broadly, what's the concept? How do you sort of create this strategy?
Okay, so double diagonal is, think of an iron condor, right? What happens
Hmm.
in an iron condor is, as long as market expires between your two short strikes, you make
Hmm.
money, right?
Hmm. Hmm.
But an iron condor is inversely proportional to the implied volatility. So if implied volatility goes up, iron condor will lose money.
Yeah. Yeah.
A double diagonal just is kind of like an iron condor only. Just the difference is, if implied volatility goes up, it will make money.
Okay.
So what you
So,
do,
yeah. Go
yeah.
ahead. Go
So
ahead.
what you
Yeah. Go
do
ahead.
is, sorry, yeah. So you create a short strangle in a
Hmm.
shorter dated expiry and a long
Hmm.
strangle in a longer dated expiry. So you're fully
Okay.
hedged. It is one
Yeah.
is to one. The only
Hmm.
difference is that you have a positive exposure to
Hmm.
implied volatility. Yeah.
Got it. So the wings basically, not, yeah, if I could call it, yeah, the wings are in the next expiry. Is that correct to say?
Yes. Yeah,
Yeah.
the hedges are in the. No, I mean, in my case, I have monthly expiry. The
Hmm.
hedges are in a later dated expiry. The short
Hmm.
options, see, the shorter dated options are going to have a higher rate of fall off in premium
Yes.
because they are closer. They're going to lose value faster. The
Yeah.
longer dated options will lose value slower.
Got it. Got it. Perfect. I get it.
Yeah.
Yeah, and because of that, you are a positive Vega because you are the hedge is in the next expiry. So I get it. In fact, Shreyas, and obviously I don't want to make this discussion about this, but maybe I'll just take 10 seconds. In coincidentally, I also noticed that there is right now a backwardation that is happening, in the sense that the current week's IV, I mean the near expiry IVs, are actually more than the next week or next whatever far month or far expiry IVs. So that is an observation that I maybe, and that also probably helps your position.
Yeah, so the two reasons for that. One, you have a Fed event coming up during this week. And
Hmm.
secondly, right now, with the whole uncertainty about the peace talks that are going to take place on Tuesday,
Hmm.
it's basically random at this point. To be very honest, at this
Hmm.
point, market behavior is news driven. So news
Hmm.
can be random. So market behavior also can be more or less random, which is
Right.
why the nearer term IVs are extremely high. Yeah.
Hmm. So fine. Let's coming back to our discussion. So tell me one thing, Shreyas, as an option seller and as a someone who is now been in this trade trade craft. What is your advice to other option sellers or upcoming traders, struggling traders? What is your advice? What are the few things you think you would want to tell them as do's and don'ts, in case you can recollect any of them on the top of your head? Any advice?
Okay, so first thing I will base off of a conversation I had today with someone is don't be in a rush. Everybody is in a rush, it looks like, to make money. And I think, in a way, social media plays a role in creating a sense of urgency to make money at all
Hmm.
times. uh,
Hmm.
Getting out of that mindset is very very important. Like, people, at a certain time, if you know that your setup is not working, rather than scaling down or taking a back seat, or
Hmm.
just laying off for some time,
Hmm.
people seem to be, I'm noticing this. I mean, for people who are not, that's great, but there's some sort of itch that you have to make money in every market. I think you
Hmm.
should take a little bit of a back seat, and think of the long haul. You're not about trading for you have to double your capital in the next year, or I mean, it depends also on what capital you're trading, but um, taking it slow, because if you want to build a career out of this, if you want to make this sustainable, it has to be sensible, in terms of how you act, right? That's one aspect. The other aspect is, I've seen that a lot of new people, whenever they are losing more, that's when they want to take the most risk, which
Hmm.
is exactly, I mean, it should be the exact opposite of that. So that is another thing. And
Hmm.
it's just, finally, look, option seller or whatever kind of trader you are, if you lack the discipline and lack the foresight, and you're in too much of a rush to kind of make some big money very quickly, you
Hmm.
are 100% guaranteed to not succeed. So I think taking a little bit of a step back and really looking at what you do and how will that not be sustainable over the years, not
Hmm.
over the next few weeks or months, is very important. um,
Hmm. Hmm.
yeah,
Hmm.
off the top of my head, that's what
No,
I
no,
can say.
absolutely. I get it. So tell me one thing, Shai. So apart when you're not selling options, what do you do? What are your hobbies?
Okay, so see, my day begins and ends during market hours, so I really couldn't care less what happens, into the evening. How I mean, I at night I will study, so that's
Uh,
that's between like 10 to 11. I will study what is happening, just go over the data, come up with, okay, what exactly is going to be my approach tomorrow. That's
hmm.
it. But apart from that, I I do random things, like I watch a lot of TV shows. I watch a lot of anime. I read manga. I've been
Hmm.
following one particular manga now for 16 years, close to.
Hmm.
I'm into gaming as of now. I used to be a huge online gamer. I used to play a lot of MMORPGs and MOBAs. I stopped doing
Hmm.
that because it's a huge addiction.
Hmm.
I think
Hmm.
the same time I transitioned out of my MMORPG gaming addiction is kind of where I got into the market. So in a way, it was a replacement.
Hmm.
I don't know. I'm this obsessive kind of person where I'm either doing too much of it or nothing at all. So that's generally my way of
Hmm.
doing anything, and that's kind of how it's been. So
Hmm.
yeah,
Hmm.
now it's mostly like console stuff, console gaming, and
Okay.
yeah,
Hmm.
just watching TV shows and Yeah, I
Got.
used to play quite a bit of like badminton and football. Not
Huh,
so much anymore. Not since the whole COVID thing. But
huh,
yeah,
huh.
it's just not much. I mean, after the market is closed, generally, I'm not really doing too
Yeah,
many market related things. Yeah.
yeah,
Of
yeah.
course, now with the whole social media thing, it's been, I think, like 1 year, 6 months since I started posting videos and like posting on Twitter. Before that, I was not even on social media. So I'm not on Facebook. I was never on Twitter. I'm not a
Hmm,
very social media person.
hmm.
So that way, I've been more of a like I just never. I don't spend any time on Instagram. My Instagram has like 6 posts, I think, and I probably check it once a month. So just yeah.
Hmm. Hmm. Right. So tell me a thing. In terms of your style of course, you earn your trading income is through option selling and other things. But when you earn that income, do you sort of use that to accumulate good quality stocks? I mean, I know, I think we have had interacted earlier, and you mentioned that you do want to then put that money to use in terms of getting good quality stocks. So is that how you want to sort of, is that how you do it, like how do you manage your investments? Trading we understand, but what do you do about your investments?
Okay. So, Gordon, here, basically, my portfolio is
Hmm.
comprised of 95% excellent quality stocks, out of which 80% of them will be just market leader one and two. So it's a
Hmm.
very like very boring portfolio. I have
Hmm.
5% in stocks which one would think are very bad quality or micro cap stocks,
Hmm.
and those have done very very well for me. I'll give you an example. I
Hmm.
posted earlier. So I bought Tanla for 38 rupees. I bought 1,000 shares. I'm still
Oh.
holding.
Oh.
And I don't know if it's a good habit or bad habit. I have never sold stocks.
Oh.
Whatever happens, I have never sold stocks.
Hmm.
So, and one more habitual thing that became very useful to me is I would
Hmm.
always have debt. I would eventually always put my account in a position where I have at least 40-50% in debt. So that has
Hmm.
always given me enough cash that I can liquidate to buy. So as
Hmm.
I generate a trading income, I withdraw money from my account every month. I withdraw between 5 to 7 lakhs. This is
Hmm.
towards like expenses and like building up this thing to pay advance tax, and
Hmm.
whatever else is there, it more or less gets invested into debt or equity.
Hmm.
And
Hmm.
my equity investing is very straightforward. I buy top quality stocks or I
Hmm.
buy ETFs.
Hmm.
And whenever the market is correcting, like for example, once it broke the 200-day moving average, every 200 points I've been buying.
Hmm.
And
Hmm.
in that period, obviously, my liquid cash and debt component will go down. But
Hmm.
once the market goes back up, I don't have to liquidate my stocks to replenish that debt. Either
Hmm.
through trading income, I will be able to replenish it through intraday trading, or
Hmm.
by doing covered calls. Like I also do a lot of covered calls against my holdings. I'm not
Hmm.
doing it. I don't have any covered calls open at this point because market is oversold. So this is where discretion also plays a role.
Yeah.
Like
Yeah.
after, for example, first time when we gapped down below 16,800, after that,
Hmm.
there's no way I'm going to now sell call options because it
Hmm.
is an oversold market and we've seen how it bounces also. Many
Hmm.
people will say, okay, why are you buying here? Why are you buying there? Because as market keeps falling, you keep buying. And I have like, for example, my strategy was, look, even if I convert out of my current 40% debt,
Hmm.
5% at a time into equity, I will
Hmm.
still be able to, like for every 200, 300 points, I'll be able to buy all the way till 14,000,
Hmm.
which is
Hmm. Hmm.
which is fine, right? And
Yeah.
I also have this thing that when the market is crashing, I don't want to lose money in trading, because
Yeah.
if you see, I will look at my account from a account level perspective. My
Hmm. Hmm.
margin comes from my equity. Now if my equity
Hmm.
is losing value, on top of that I'm losing money in trading, that is not going to happen. So I will reduce my risk appetite when my collateral is going down
Got it.
in value.
Got it.
so
Got it.
so that's kind of how the whole thing works. And
Hmm.
I think so far it's done very well for me. And I think the habit of not having sold stocks because I don't feel pressurized to sell stocks. I'm not overexposed to them. I have gold, I have debt, I have liquid funds, right? I have all this cash. And I think one more thing that plays a very big role here, and I think that has helped me, since when you're trading, no, if you're booking some profits, it takes away that tingling feeling to say, boss, let me book my portfolio profits. Like I have some stocks that have run up 4 times, 5 times in just the past year. Now, why am I not booking out of them? Because I don't feel that okay, I have to book and realize this profit because I'm realizing somewhere else.
Yeah, yeah.
So that helps with psychology. Yeah.
No, absolutely. I think when you know that you have a fairly assured, I mean, nothing is assured in markets, but fairly assured kind of a trading income, over a period of quarter or a year or half year. I think you know that that income can always be put to use if the market corrects, and you can average it. So the urge to book profits or urge to feel afraid of corrections goes away. I mean, to a great extent.
Yeah.
In fact, I do end up doing something similar where all my portfolio is invested in some ETF, and then I do options selling to generate additional income, which I then reinvested. So yeah, pretty much in the same boat, I would say. Great. So, Shreyas, before I start the audience round, I have one final question, and which sort of came out from the point that you made earlier about covered calls. Okay, so if you could just help us understand, very briefly with an example. Suppose, example, you have, let's say, I'm just using one example. I don't know if that's your stock, but say, example, you have Bajaj Finance. Okay, and you own say, X number of shares. Now, what is your thought process in terms of how would you sell, which strike, or how do you decide at what call strike you would execute the covered call? I mean, just if you could help us understand a little bit on that, just as an example.
See, Gordon, at the end of the day, I mean, covered call is basically selling a call option against your holdings, right? Now,
Right.
at which strike you execute, it purely comes down to where is the resistance that you see and also what is the view. See, everything at the end of the day has to come from the chart. You need to be able to see that, okay, where is their supply? So you find a place of supply and you sell it above the place of supply. And the thing is, here also, there is something that plays a big role. Even if I were to sell covered calls against all of my stocks, 100%, I will not even be using 2% of my available margin in my account. So if those calls start bleeding, it's very, very, very unlikely that I actually book a loss on the position. Because first of all, the stock moves up, I'm gaining on my stock, but I'm not planning to book my stock. I'm not going to sell it. I'm not going to sell it off. I have a lot of margin which I can use to come out of that trade profitably. It is very, very unlikely for me to actually book a loss on any of those call options, even if they go super deep in the money. First of all, I will initiate them out of the money based on wherever I see a particular. It depends on what I'm expecting the market to do and that stock to do, right? If it is, for example, extremely oversold, I don't want to sell a call option because I will get peanuts. And against it, if there is one short covering move, then it's a very bad trade to take in an oversold market. You don't want to cover your shares, which is because I don't mind the downside. It's the quality of companies that I'm holding. Okay, there might be some short term pain that will be used to add. And so strike has to come from looking at the chart. Just look at where is supply, sell above that. And if you have enough margin, if you're using barely like 1.5-2% for all these covered call positions, you will be able to come out of that trade profitably. It should not be a rocket science. Yeah.
Got it. So that, I think that was a key point that I wanted to know. So because there are various techniques of covered calls, right? The technique that you follow is looking at the charts and looking at the resistance. There are some other people who they have a standard policy, like for example, they will look at one standard deviation above the current price or two standard deviations, something like that. So that's what I wanted to know from you. Is it something that you have a chock-a-block, like a straight jacket approach, or like a defined approach, or you go individually as per the so I think the answer is the latter.
Yeah, the answer is the latter there. Yeah.
Cool. So let's open it up for the Q&A. I'm sure huge number of questions coming up. So let me start off. I'll allow a couple of people to start off with. So Rishik Bajaj, why don't you go ahead? Yes, we
Yeah,
can.
hi Shreyas and hi Gordon. Thanks for making this space.
Hey, Rishik, sorry. I forgot to make a quick announcement. Two things. Please make your question very brief and very concise because there are so many other people who want to ask. So let's be very, very concise in the question. Okay? Yeah, please go ahead, sir.
Yeah, this is Ajit from Trade with Tommy Twitter account. So Shreyas, hi. So my question was very simple. How you are using collateral and what was the most benefit you are making from collateral? And I don't aware about the Nifty Bees ETF. So can you elaborate whether you can make collateral by using the Nifty Bees ETF? Something you have talking.
Yeah. Hi. So great question. And so the answer to this is you don't need to have cash to trade, right? You can use your holdings to give you margin. Generally, there are two forms. One is cash equivalents, which basically counts as cash as far as margin is concerned. And then you have collateral against equity. So all brokers, what they'll tell you, especially if you're trading positionally, is that you need to have 50% of your margin come from cash or cash equivalent, and the other 50% can come from stocks, ETFs. Nifty Base is the most liquid ETF that is there for Nifty 50. Basically, when let's say you purchase 1 lakh rupees worth of Nifty Bees and you pledge it with your broker, I think there's a 8 to 10% haircut. So if you pledge 1 lakh worth of Nifty Bees, you will get 90 or 92,000. I'm not sure if it's 8 or 10, but you will get that much margin. Now, why would I do this? The reason I do this is there is no opportunity cost. By doing this, in case I don't make money also on my margin is not sitting in cash. And especially because I'm an intraday trader, I can have more than 50% margin come from ETFs and equity. And that is what I do. So even if I don't do anything, assuming Nifty gives me bare minimum return of let's say 8 to 10% also, I'm not missing out on anything. Whereas if all of my trading margin was to come in the form of cash, then if I don't make money, I'm losing money to inflation. Right, I'm losing money to the fact that I'm not even getting FD rate of return on that cash. Is that making sense?
Yeah. I generally remove the speaker once his question is done. So I
Okay.
guess I guess that should. Rishik, why don't you go ahead?
Yeah, thanks a lot for giving me a chance. Shreyas, I saw a video on Face to Face with Vivek ji also, and I heard you talking about your strategies. I just have one question, and that is regarding discipline. Okay, so like I have been trading, and but I don't I lack discipline a lot. So how do we develop a discipline, and how do we stick to one strategy? And I have heard a lot that you just keep doing it and like keep doing the same strategy if you have faith in it. But the thing what happens is that we tend to lose faith when there are like lot of wrong things happening. And then how do we get back to the faith, and how was your story, and how did you get back? So that's my question, basically how to develop a discipline.
Hi, Rishik. Thank you for your question. So, to put it very bluntly, either you do it or you will not make it. So, one thing everyone has to clearly understand is that the markets are the most dangerous place, and you are definitely the weakest person in the market. There are people out there who have spent billions to try and get a little bit of an advantage over you. You have the worst execution, you have the worst analysis, and for all practical purpose, please understand that you as an individual trader or me as an individual trader are the weakest participants here. So as I said about long term thinking, if you want to survive, inculcate it into your bones, otherwise you will not. Now there are ways to hack into this, and you have to find what hacks work for you. The way for me, what works lately is whenever I see that I'm going to be indisciplined in some way, I've hardwired myself to remember all the times the big, massive negative mark to markets that I've sat on and how much of a loss I've booked. By repeating it in my head, I've brainwashed myself in a way that even if I make a profit after acting indisciplined, after doing something which is very revenge type of trading, then I've hardwired myself to feel disgusted with myself about it. There's no one way that will work for all, because you're trying to hack into your psychology. You need to find out how do I brainwash myself. I'll give you another example. Today I took a double diagonal trade. Why? Because I just didn't want to take an intraday trade, and by taking a much smaller position in a double diagonal trade, that urge to trade or whatever, I managed with that. Where in case I do hit a stop also, it will be completely insignificant. So there are at different points different things work, but to put it quite simply, either you do it or you will not survive. You have to ask yourself, is this a career or are you like fooling around? Because if you can't respect the rules that you've made for yourself, like for example, I have this thing that if I take a stop loss for a day, I will not re-enter no matter what, because and that's easier for me to do because I can remind myself of all the times that I did not follow this and I messed up big time. And if I'm really questioning myself, I have something else that works for me, especially if I'm having like confidence issues at any point of time. I go back and look at my previous ledgers, my performance, the video logs that I make. I watch them. Nobody else has watched my videos more than me, because for me it's like a trading diary. That's my trading journal. So I go and watch and say, okay, this is what I was thinking. Look, I did this. It worked out for me, and that's why I'm still surviving today. So you need to figure out what is it that you can do to bring in and inculcate that discipline, because really there's nothing else that is required for a trader except for discipline. You can be zero in analysis, you can be zero in everything else. As long as you're disciplined, you have a future. So that's more or less how I would answer that.
Great, fantastic. Game Ram, go ahead.
Hi, thanks, Gordon. Hi, Shreyas. So this question is basically regarding the capital. Okay, how one should plan the increasing the capital size. I mean, you have yourself taught us. Like I follow you on your YouTube and your trades, your videos, and all. Thank you for all the teachings. But my question is about capital management with risk management, right? So you have always told that around 3 to 5% is something which we can decently expect from the market, right, on an average. So how should one increase the capital size if you are successfully able to make profits, right? Still, what was your journey there? Could you please share it with us? How you increase the capital?
Yeah.
Thank you.
So thank you for your question. And so I'll put it in this way. When you start out, until you are very confident in what it is that you are going, at least everything as to how the market functions. First of all, many times when people come into the market, they don't even understand what are all the ways. Like for example, what are all the ways you can trade? Has somebody experimented with, okay, these kind of spreads are there, this is what a calendar is, this is what a diagonal is, this is how you create debit spreads. First experiment and understand everything, understand that these are all the ways to trade. When you do that, you will figure out where lies your comfort. And until you know what you're doing, like know what you're doing as in you really know in and out of what you're doing, you should not be bringing any considerable capital. And to be honest, in that phase, it's not even about making money. Many people post and say, look, in the past year I've generated this much return, am I doing well? I have no idea. But if you feel that confidence that, okay, I know what I'm doing, then you have to bring capital. Look, if you want to do trading seriously, you have to bring capital. You take, for example, anyone who's passing out of college in any urban city, let's say working for an MNC, they will start at a CTC of at least 5 lakhs, and after a while, your peers, assuming you're around 30, they'll be making 10 to 15 lakhs per annum. And if you want to put in all this effort into trading, if you're not able to generate the same amount at least from trading, how is it worth it? How is it sustainable? How would you feel like you're doing something? So I think as far as learning phase, until you are completely confident in the strategies that you're executing, be it intraday or positional, you should not bring any considerable money. It is just senseless to just come in with a big chunk. Once you have a very clear idea, if you want to do this seriously, you have to bring serious capital. Look, as far as my trading capital, I've added 30 lakhs, and this has been now 4.5 years plus since then. And I have not added any capital after that, because I just, whatever was there in my account, for the longest time, I just compounded that, tried not to pull out cash. At this point, I have to pull out cash because there is no other way to pay your taxes, and even for your expenses, you will have to pull out. So initially, while you're building up your capital, if you can minimize your expenses to an extent where you are not slowing that process of compounding, that's great. But after a point, it also has to be a sustenance. So yeah, in terms of what is like reasonable capital, once you know what you're doing, I think if you're coming to the market with anything less than 10 lakhs and you are like, okay, I'm going to do trading seriously, it's not going to happen. It's just not going to happen. And you need to convince people that, look, there's no dearth of capital out there. If you know what you're doing, people will give you money. There are enough number of people where if you walk up to them, and recently we had a guest on Face to Face also who really practiced with his own money for a while, for about 2 years, and after that there's somebody who he discovered through Twitter who gave him close to 50 lakhs of capital to trade with, and today he's doing it extremely well. So there's no dearth of capital. It's more about, do you know what you're doing? Because even if you don't have capital, people who can see that you know what you're doing will give you capital. So it's not so much like that. Like, I'm sure Gordon gets this often as well, but any trader that is known and has proper reputation to back him up with his reports and everything, companies will come to you and say, manage our money. They will say, okay, we will do a revenue sharing of like 15%, 20%. You will have institutional desk guys approaching you saying that, can you manage this much capital for us? Because there's no dearth of capital. Rest assured, there's no dearth of capital. You don't need your own capital as long as you know what you're doing, and you reach out to the right avenues.
Absolutely. Shivansh, go ahead.
Thank you for the opportunity, Shreyas and Gordon. I just had two questions. One is on literally on the technical side, and one is on the psychology side. So the question was on the psychology end was that how do we differentiate luck from skill? So on that context, what I've been observing is that I've been selling 10 delta and 15 delta strangles for quite some time, and I feel that it is going okay. Like, and I think I can work on it, and it might work better
Positionally
as
or
Shreyas
intraday?
mentioned. Intraday Shreyas.
Okay.
Right. So basically, it is very similar to how you trade, and I actually got inspired. So I was trying to build something around it. So how do we differentiate luck from skill? And the second question was on the trade that you took today. So you took a double diagonal calendar spread. So I just wanted to know the reason that why would you take monthly hedges instead of next expiry hedges? So if I was trying to look at the Greeks. So if we take the next week expiry and this week expiry, the Vega to theta as a percentage is only 30%. But like if I look at Vega upon theta for the next month with the monthly hedges for this week, it is quite high. So we are taking a lot of Vega exposure in that sense. So just these two questions. I would be happy if you could answer that. Thank you so much.
Hi, thank you so much for your question. And yeah, so let me get into the first part. How do you differentiate luck from skill? Timeline. You can be lucky on a short timeline. That short timeline can be a couple of days, can be a couple of weeks, couple of months. In fact, can be sometimes years also. But if you have had consistency in that, and you don't have any single, because you're an intraday trader, how you should judge yourself is by what is the largest loss you've booked in a day. More than anything else, and how does that compare to your average profits? As long as that is at a ratio of 1, if the largest loss you're booking versus your average profits is 1, then that is excellent. But even if it is on a little bit of the higher side also, it is okay, provided that you do it on a long enough timeline. So the only way to answer that question, am I getting lucky or is am I like working off an edge here, is timeline. If you've been able to do it for, like, let's say anything more than 2-3 years, I would not consider that luck. And okay, for your second question, first of all, why Long Vega? Because if you see what I posted in the morning, there was close to, as far as 800, 900, 1000, 1100 wide spreads were concerned, there was close to a 20 to 30% fall off in all of them. of premium over the weekend. Now, in that scenario, I do not want to short volatility in the current nature of market, which is why I took a long volatility trade. Why monthly hedges over the next week hedges is because I'm not expecting an immediate crush in volatility. See, unlike an event like an RBI event or a budget event where as soon as the event is done, there's going to be a huge volatility crush, the current nature of uncertainty is not as such. So it's not like you're going to have any particular thing where tomorrow morning there's going to be a 20% crush in IV. So that being the case, wanting to have more of a long IV situation with my trade, I use monthly hedges. One more reason for using monthly hedges is that the liquidity is much better. So if you're punching an order for, let's say, max lots, my trade has 2 max lots, 2800 into 2. I would prefer executing market orders on monthly versus weekly, and it's not going to make that big a difference. To be honest, if you've traded double diagonals for a while, you'll realize that it really doesn't make, you want to be long Vega, it really doesn't make that big a difference whether you use the immediate next week or like 1 week after that. But yeah, the idea is to be long Vega quite substantially.
Yeah, great. Tirupati?
Thanks, Gordon. And thanks, Shreyas, for the opportunity. And my question is mostly related to the tax. So actually, we all know earning is a good thing, but saving some taxes is also required while we are paying a lot of close to 40% tax when we are earning more. So what is your guidance? I have gone research somewhere opening a corporate account will enable us to save some extent, maybe close to 5%, flat 25% for corporate. But there are a lot of compliances also included and a lot of charges. So what is your suggestion to, either we should go for LLP or private limited, or should we trade with individual? So maybe if you can provide some light on that, yeah.
See, I trade in a private limited company, and I have a video on how I do that and what are the specifics. But basically, to the extent possible, beyond a point, you want to reduce your tax incidences. You want to be able to expense as much of your profit in the right way as you can and bring down your tax liability. If you trade in a private limited company, your tax bracket becomes 26%. And on top of that, whatever profit is there on your gross profit, if you can have a lot of expenses, whatever director expenses are there routed through the company, that way you can bring it down, but you can only bring it down to that extent. I think whether considering an LLP or a private limited company, I would think unless you were making at least 50 lakhs of profit, it's not worth doing all that, because then there is a compliance cost. You have to have a CS, you have to have a CA, you have to have filings, you have to have all this back-end mechanism. Your accounting needs to be on point, because if you want to show expenses, you need to have all the bills for whatever expenses you're making. You need to have, if you're doing rental, you need to have a rental agreement and all those payments. So I would think unless you're reaching a point where your turnover is very large and your profit is exceeding, I'd say ballpark figure, I would say below 50 lakhs, you shouldn't consider. You can trade in an individual account. If you're crossing 50 lakhs, then your cess starts coming into play. This is basically what happened to me. I was trading in my account and my father's account, and my above 1 crore, you start paying a huge cess. It's like a 15% cess above 1 crore, which is that 15% on top of I forgot the exact calculation, but net is working out to 42% plus. And at that point, you can think of, okay, let me restructure the whole trading operation. But until then, I don't think you should consider it. And even if you're trading in your individual name, you can to some extent show expenses and to bring down your tax incidence, but not more than that. I have a full video on this. I think you can just look it up on YouTube, and I've gone over that.
Cool. Great. Anbu, you can go ahead.
Yeah, hi Shreyas. Thanks for opportunity for have time with you. And actually, I am following recently few months of your trading style. Mainly, I just big fan of your expiry day trading. So even I just following the same style, and I'm getting much better through my uh, through my outcome. The thing is, but I have been already working with some other profession, and I'm just doing the exact the way the increasing capital and slowly moving away from my nature of job and to trading once I get the capital. But the thing is, I could able to only the positional trading only conveniently I can do it. But the atmosphere of these movements and the overall trading experience, I'm not convinced, and it's very difficult, and even compared with India weeks and everything what usually people says, it's very difficult to read it. So as a experience, as per your experience, how you recommend it? This is because of the India weeks or something indicator is enough to read the environment and play with, or it's very hard to keep going like this, uh, like a positional trading? Because I just observed you have not much play with the positional trading. So throughout, I just observed you are mostly doing intraday trading. So how you recommend for the part time like option sellers? How you recommend, or how I have to prepare for further events, or what are the things I need to mind it? Thanks for advice.
Hi, Anbu. Thank you for your question. So, first thing to address right off the bat is you can't be a part-time trader and trade intraday or trade expiries. If you're trading an expiry, you have to be there from the beginning of the day till the end of the day. I would think anyone who's leaving an expiry trade open is quite reckless. It just doesn't make any sense unless they found a way to automate it. As far as positional trading being difficult, it's not so much of like specific India VIX, but whenever there are events or global uncertainty, if you can't dedicate enough time to your trade, you just have to avoid trading. Some people might say a rough ballpark. I mean, it makes no sense whether it is 25.01 or 24.99. But if VIX itself is above 20, then you know that that is a higher risk and reward environment. You can't trade the same way you've been trading when VIX was at 15, 16, 17. So if you're having a tough time with positional trades in the period, just exit the market for some time, because you don't have the if you don't have the full time to be able to commit to the market. Or one thing is, take a complete backseat or trade 20% of the size that you were trading before. You have to kind of get used to the fact that in all markets you will not make money. So this is one of those markets where it's not great if you're a positional trader, and if you're a part-time trader, this is not a great market to participate if you're trading shorter dated expiries. If you're trading weekly expiries, it's impossible. If you're trading monthly expiries, to some extent it is possible. I mean, as long as you are not completely naked in that position. If you are somebody who trades 45 days to expiry plus all the way to 90 days to expiry options, then probably that also could work out all right, because it gives you enough time to react. Basically, what you're going for is you need to have enough time to react when the nature of market is much more volatile. And if you don't know such a system, you're not comfortable with such a system, just sit out. Just sit out during this uncertainty and wait for a period where your style will make more sense. Yeah. And you
Great.
cannot be an intraday trader if you are doing something else. Many people say you can do intraday trading doing other things. I think that is impossible. I don't see it being possible. Some people automate it, but even then you have to see, in case exchange breaks down, in case your broker breaks down. Let's say you have 100% automated intraday strategy, but exchange is broken down, your stop losses are in the system and they got cancelled. I mean, that's not a viable excuse, provided you're doing it with sizable capital, the capital that matters to you very much. And yeah.
Yeah, absolutely, Shreyas. Good advice. Manoj?
Yeah, hi Shreyas. Actually, I'm doing few strategies in Bank Nifty. I'm able to do it in Nifty, but when the quantity is very huge, I'm facing little bit of higher slippages. So, like, but if I do it if I splice the order, uh, my thing is whether the brokerage will be on the higher side, or will it be manageable? I'm not sure. But to reduce the slippage, will order slicing work? Or I'm using Zerodha like for 20 rupees per order. But I'm just concerned, will the brokerage be of Fireside, or is there any reason like you're still using 2800 even though slippages are there without splicing? Just a doubt from my side.
Yeah, hi Manoj. So see, slippage is one of the fundamental truths of the market. There's nothing you can do about it. If you're trading Bank Nifty into momentum, Bank Nifty will always have higher slippage. There's nothing you can do about it. So that is out of the question. You can break your orders into more chunks. See, generally what I do if I'm position sizing between 15,000 to 20,000, each order of mine will be around 5,600, which will be sliced into 2 orders. Since I'm placing orders on both sides, sometimes positive, negative slippage balances each other out. But other times, on average, I would account for close to 1 point in slippage on a daily trade. 1 point in slippage is something that I've accepted. You have to also, I'm trading Nifty, I'm talking about. You have to also accept. One more thing is that in certain scenarios, and this depends on your size, when you know that momentum will pick up at some point of time, let's say you're looking at a breakout or a rejection level, then you're probably better off exiting that trade before that breakout happens or that rejection happens. But you can't do anything about slippage. Slippage is slippage. We're working through a slower mechanism. Our orders have to go to the broker. From the broker, they have to go to the exchange and execute. I also don't have an answer to slippage. I keep working on how to make it better. I've developed a mechanism with Zerodha's APIs where I use a market protection order. So when I place my order, the maximum slippage on it is limited. But the minor slippage that happens, I can't do anything about it. All my orders are limit orders. So they are all limit orders. And every order of mine, I always underbid and over ask for in order to get a fill. But it is a limit order. So.
Hey Shreyas, how are you?
Hi Ranja, how are you?
All good, all good, all good, all good. Bro, I have a question. On expiries, you trade the huge quantities in a single strike. Rather than going with a single strike, why don't you manage Nifty and Bank Nifty both?
Too much work. I'm a little lazy. No, but on a more serious note, see, I want to keep execution as simple as possible. I don't want to complicate my work by trying to do too much at the same time. Effectively, the way I see it, it makes no difference whether I'm trading Nifty or Bank Nifty, except that if I'm trading Bank Nifty, my risk to reward would be much better than trading Nifty. But at the same time, the amount of management that my position might have to undergo will also go up. See, for example, let's say on an expiry, I'm targeting 1% return or 0.5% loss. Okay, that's what, let's say, my approach to a particular expiry is. If it was twice of that, if I was targeting a 2% return or a 0.5% loss I'm willing to take, then I'll trade Bank Nifty. And I think what ends up happening is you build as a trader personal preference. Like it is more of your comfort zone. Now, there is no reason anyone can say trading Nifty is better than Bank Nifty or vice versa. That's a senseless thing to say. But it comes down to what are you most in sync with? For me, I find that trading Nifty, I'm always in a very comfortable zone. So I prefer to trade Nifty. And for somebody else, they are comfortable trading Bank Nifty. They want that higher risk to reward, then great.
Because I do it like I do 50% Nifty, 50% Bank Nifty, and doing so I get an advantage that because at the last end, or you can say last 30-40 minutes or 1 hour, Nifty strikes, the next strike is very cheap. Okay, I can sell next strike at 20 and the next one is at 1 or 2 rupees. So I think in Bank Nifty we have a benefit of that there are 100 and many strikes, so we can sell Bank Nifty also.
Correct. But like, I mean, I'll give you an example. Recently, I think 2 expiries back, we had one big short covering up move, right? In Nifty, that 1 rupee option went to 36 rupees. In Bank Nifty, that 1 rupee option went to 120. So everywhere, the risk and reward is always proportionally balanced. It's all about, like, you get higher premiums in Bank Nifty and you get, like, you get to pick between more strikes with value in it. But the risk also in Bank Nifty is accordingly, right? So I think it's a balancing act. And really the only answer is it comes down to what do you prefer? Like there is no this is better, that is better and all that. Yeah.
Right. Suresh, go ahead.
Hi Shreyas, this is Suresh. In initial stage of your trading career, did you compare your P&L with anybody? And did you got any form of fear? Because I'm getting low money, earning low money with compared to others. And how did you overcome this issue?
Hi, Suresh. Great question. So, to be very honest, it's difficult at times to not compare yourself. But this is kind of where you have to understand your behavior. So, look, sometimes when you see someone making big profits or generating large ROI, you have to understand that it just is doing only harm to you by looking at them and feeling bad or feeling good about yourself. So over a period of time, as you're a trader, as you start to deal, see, at the end of the day, it's all about traders find ways to manage their behavior. You might end up causing a lot of harm to you if you try to replicate what somebody else is doing. Somebody will come and say, today I doubled my capital. But the thing is, you might not be able to do that. You might not be, like, for example, I have a friend. What he does is, in his account he keeps only 10 lakhs. Every day he tries to double it, and if he makes profit, he will pull out that profit. Tomorrow again he'll trade only with 10 lakhs. He's an excellent trader, by the way, right? So every day he's generating 100% ROI, but on only 10 lakhs, and no matter how much profit he makes, he will remove it. Now in case he loses, he will lose, let's say, 5 lakhs. He will add another 5 lakhs. That is his trading style. He does extremely well. As a trader, I think once you spend enough time in it, you'll realize that the only thing that will work for you is to figure out where you are confident and comfortable. So eventually you'll stop comparing yourself because, somebody, so many times people come and say to me, boss, like, I came up with this trade idea. I created this trade and then it gave me 3x return. Great. But they did it on a capital of, let us say, X. Now, if they had 500X, would they run the strategy? They wouldn't, right? So it's different for different people. I think over time, as a trader, you kind of teach yourself that you have to stay in your own mind space and not get too influenced. That's where, like, social media, one has to be very, very careful, because more often than not, the effect of social media on people is very negative. And I think social media has also glamorized being able to generate double-digit returns on month-on-month basis, which I think is complete stupidity. And it happens. You do compare yourself at times. Like, for example, at the end of the day, you'll say, okay, how did I do today? How did XYZ do today? But over a time, you'll also teach yourself to not do that, because your definition of risk reward, your way of trading will be very different to somebody else.
Right, right. Shreyas, before I invite the next person to ask question, it's 10:30. I hope you don't mind if we go on for the next 15 minutes.
Yeah, that's okay, Gordon. Yeah, I have not much to do right now.
Great, great. Okay, option trader, go ahead, ask.
Hey, thanks for the opportunity, Gordon and Shreyas. Hi. So I have two questions actually. So one is, given the current volatility, I mean, so I closely, follow you on Twitter, and I've seen how you build your positions and how you manage the positions throughout the day. So these days, right? So as you keep mentioning that the IV crash or the volatility crash that majorly happens overnight and it doesn't really realize throughout the day. So how do you manage your mindset when your MTM doesn't seems to be coming in green? It's mostly varying between like slightly 2 points, 3 points gain to 3.4 point loss. That's question number one. And second is, I trade in Bank Nifty, and I kind of want to learn the art of expiry trading. So basically, I trade in only straddles with combined stop loss, and these days it's like I am trading as if I have to give a stop loss to the market or brokerage to the broker. So was there any situation that you've been your stops being taken very continuously, and how's your mindset? Thank you.
Hi, thank you for the question. So I'll go over exactly, for example, what my current trading situation is like. See, you have to understand, right now, the put side IV, for example, and I'll try to keep it as less technical and Greek oriented as possible. Puts have a lot of premium, right? And into a gap up, puts are sometimes, most of the time, giving up whatever value they have to give up right into a gap up, and calls are gaining in premium. So actually in the current scenario, the way I see it, gap ups are the best time to take short volatility trades, because at least whatever IV spike is there in the calls has the potential to fall off. Flat openings or gap down openings are turning out to be the worst case scenario for short volatility trades, because what is happening, the puts are already inflated, they're not gaining as much, but calls are losing all their value at the open. They're going to half their value. Now in that scenario, the only thing that happens is into an up move, the puts are not losing and calls are gaining. This is the current nature of the market. Now that you've understood the current nature of the market, start looking at, okay, if premiums are high, but what has happened between yesterday closing and today opening to the premiums? The way I look at it, if the premiums are the same or more, I will enter that trade as quickly as possible, because it means that I'm getting the same risk to reward as what closing was there yesterday. If there is on a spread which is more than, let's say, 800 points wide, if there is more than a 20-25% fall off, I would best prefer to stay away. Now, this is my current idea in the market. As far as how am I dealing with it, the fact that my stop loss is going to get hit, nothing I can do about it. In case I feel that, okay, the risk to reward is bad, I will choose not to trade itself. Otherwise, if I do trade, I will take my stop loss. One more way to avoid that is trade lesser sizing and keep more of a stop loss. See, for example, you're saying you're trading bank nifty straddles, and that is now these days in this current market, it's stopping you out all the time. Now, when you know that it's stopping you out all the time, why don't you instead trade just half of your size or 1/4 your size, and instead, let's say previously you used to keep a combined stop loss of 20%, you make it a little bit more. For example, you make it 30% or 40% and see if that is working out. So you can't trade all markets in the same way. The nature of volatility itself keeps changing. In my view, every 3 months, the nature of the of intraday volatility changes. It's about how quickly do you catch on to, okay, what is the current nature of intraday volatility, if you're trading strangles or straddles for that matter. So accordingly, how should I position myself? My current approach is keep my position size smaller and widen my stop losses by a little bit. Previously, if I was taking, let us say, 7-8 points of risk on the Nifty every day, now I'm able to push it till about 12-13. But beyond that, I'm not letting it go. Previously, if I was trading, sometime back I was trading around 40,000 size. Now I'm trading hardly 20,000. So I'm half of what I used to have previous exposure. So these are the things you have to do. And the way I see it is, if I'm making money in a period in a certain kind of volatility, when I feel that I've got a grasp on this current nature of volatility, I will try to maximize in that period. If I'm losing money, I will actually stop trading or I will reduce my size in that period. You will not get a very good hold all the time. And this happens. Like, so in some months you will return extremely well, in some months not so well. So you have to make slight tweaks here and there to match the current nature of intraday volatility. You can't trade the same thing that you were trading at 15 weeks and say, now I'm getting stopped out all the time. Reduce your size and increase your risk appetite.
Right. Tejas?
Yes, sir. So thank you, sir, for the opportunity. Shreyas, sir, I just want to ask you one question. So most of the time, I have seen your punching order at 9:16, sir. But like on week's chart, the first 5 minute candle or 10-15 minute candle, the IV shoots up, sir. So how does it help, sir? Like punching order at the opening at 9:16, sir.
Hi, Tejas. So this depends really. It is a double-edged sword. See, the way you see it, right? Between 9:15 to 9:30 and 3:15 to 3:30 is always a double-edged sword. You can make a lot of money or lose a lot of money in that period. Now, the way I see it, in case I'm expecting there to be a sudden IV spike due to a big gap, then I will try to enter the trade very quickly. If the net premium from yesterday to today is not fallen off much, if it has fallen off very little, for example, let us say it is a Friday close to Monday open, or Monday close to Tuesday open, or Tuesday close to Wednesday open. If there isn't much of, and how do you define much? It depends on how much width you're trading and how much time is left to expiry. That is why, as you practice this more, you'll get a feel of, okay, when do you try to enter super early, and when should you wait a little bit to stagger your entry. But to put it if you did it on a random basis, it will more or less balance each other out. So when you're taking an early entry, sometimes you'll see that in the first 5-10 minutes only, you've made already 5-10 points of profit on Nifty, which can be huge. But it's also possible that there's a very big delta move in that first 15-minute candle, and you're taking a mark-to-market loss because of that. So I think if in case, you want to avoid that randomness until you get a better, because at the end of the day, this is about better understanding through experience. You can stagger your entry. Like you wait for the first 2 minutes, enter like 1/3 your position, wait for the next 5-minute candle and then enter 1/3, and then wait for the next candle and then enter 1/3. That also can be done. That will reduce the randomness.
Right. Okay. Jana Krishnan.
Yeah, hi Gordon. Hi Shreyas. Actually, my doubt is related to equity. I could see like recently, as most of the blue chip stocks are available with like good discount, I was seeing like you started to accumulating or just basketing those quality stocks for long term. So my doubt is like most of the stocks are I could still see like which are like trading below 200 EMA or like SMA in daily, and so whether like even most of the stocks are still in like low sort of like scenario. So on generally people used to say like we shouldn't time the market. So on what basis you started to accumulating those stocks, and in general I just want to understand like how you will be like approaching that equity while you are like accumulating and all.
Hi, Jana. Actually, you only answered the question. You shouldn't try to time the market. So the way I see it, I know for a fact that I don't know in how much time, but I know for a fact that HDFC Bank is going to make a new lifetime high. I know for a fact that Bajaj Finance will make a new lifetime high. I know for a fact that Nifty Bees will make a new lifetime high. So when I know for a fact that these guys are eventually going to make a new lifetime high, I cannot time the bottom. I cannot time the bottom and then get in a lump sum at the bottom. So my preferred approach is that at certain levels that be it in stocks, I will mark out those levels in stocks, be it in ETFs, I'll mark it out on the index. I have, let us say now 40% in cash and debt. I will slowly transfer all of that. And generally the way my current plan is structured, even if we fall all the way till, let us say we have a correction all the way till 13,500 on the Nifty, I will still have cash to purchase the same quantum at the different levels that I want to buy. So the answer is what you said only. I don't know how to time it. Some people will say, okay, I will only buy once it goes against above 200 DMA, and that time, once the momentum is positive again, I will buy. That's fine. That's their approach. My approach is, as far as my investing is concerned, it is ditto opposite as the mindset of a trader. Because a trader's mindset, you buy what's going up, you sell what's going down, right? You don't try to like do the reverse. Whereas as an investor, and especially when see, what am I buying? I'm buying market leaders who have great fundamentals, and I'm buying ETFs. So I know for a fact that these companies are going to do well, and when the turnaround happens, you'll not be able to buy. It will move so quickly that you don't know. You feel like, okay, like recently when it fell to 15,600, many people would have said, no, I'll wait till 15,000 to buy. I'll wait till 14,500 to buy. You blink an eye, we're already 1,000 points higher. So it's not going to be possible to do that. So my funda is very simple. Right now, the way I see it, for every, at this point, anything below 15,500, for every 200, 300 points, I will convert that 5% of debt into equity. And look, one more thing that I want to remind people is people think short term. I am the happiest person in a correcting market and in a down market because I'm going to keep earning and generating active income for minimum the next 20 years of my life. I'm not going to retire before 50. So 20 years of my life, I'm going to be accumulating assets. The lower my cost buys, better. People will look at red portfolios. People say, oh, I bought HDFC Bank at 2,500. Now it's come down. Yeah, so that's fine. That's good. Have you stopped earning money? Are you not going to make any more money for the rest of your life that you're going to invest? You are going to. So you keep adding, and especially some people will like stop your SIPs, wait for lower levels, and all. I think that's bull. The whole concept of systematic investment plan is that you're systematic about it. So I wouldn't break my head too much in terms. See, very simple funda. Keep cash. Don't ever be all in on equity, so that, because the reason you're keeping cash is not to get that 6% debt instrument return. It's so that you can buy at the right times and have a plan for buying. Don't do it randomly. Don't be like, today market is down, I'm going to buy. Have a particular plan for it and make the necessary arrangements in terms of having the other allocation in terms of cash and gold and all that.
Good, good. Ashutosh?
Yeah, hi. Hi, Shreyas. Hi, Gordon. Thank you for the opportunity. Shreyas, I had a question, but in the midst of all the people's asking you, my one of the question got answered. The other thing I wanted to say, like, I have been seeing face to face and other following Twitter traders, but I have never seen anyone so conceptually cleared about what he is supposed to do. You are very means like what you are talking is almost visible in your work or in your post or videos, I would say. The other thing is I wanted to thank you for it that you made me believe that there is just for the purpose of making money as an option seller, there is no need to trade near OTM or near at the money. Even if you trade far OTM, you can earn decently, and that would be a consistent thing. So from the bottom of my heart, I thank you for making me believe that money could be made by selling far options also, and also by making 10-15 points daily. You could make a good living if compared to the fluctuations of a trader who is trading at the money. The question which I wanted to ask was answered, although, and it was in relation to that how in that as I have also seen that you have punched most of your orders at 916 or 917 around 917 is hardly a case. 916 only you place your order. So even I was of the opinion that how you decide about the IV crash that is supposed to happen. Just one ask from my side: is it relevant to see the IV chart at 9:15 itself? Would that also help to understand that there's a gap up or sorry, there's a huge IV spike or something like that? Will that help?
Hi, Ashutosh. Thank you for your question. To put it quite simply, I'll tell you what I do. I don't look at IV charts. I don't look at IV charts mainly because if you have traded the same option, let's say it's a Monday, and you have traded the previous 100 Mondays, and you have traded Mondays on all kinds of India Wix levels or IV levels you have traded, and you know that okay, between Friday and Monday, first of all you have to have your homework in place to see what was the closing price of different spreads, and you are seeing either no fall or some fall or a large fall or an increase in those spread pricing from Friday to Monday through experience of okay, how is this option behaving. First of all, you need to already know what strikes you're planning to enter and ideally at what price. In my mind, for example, in a day when I'm entering a strike, beforehand itself, I have a rough idea of what premium I want to sell it at. If it is above that premium, I will try to enter as quickly as possible. Like, for example, what closed for 130 rupees this morning opened at 100 rupees. I knew for a fact that if it opened anywhere below 110, there's no chance only for me to trade it. 115 would be like, I would consider 120 would be great. But 120 is too opportunistic. It's not going to happen that way unless there's a big delta move overnight. You will get this only through experience. There's no substitute for it. And you don't have to look at any IV chart. You can work purely on the premiums. I don't look at the Greeks of my trade. I never open up the Greeks of my trade to see what is my trade, because you get a rough idea of what are the Greeks of your trade just by having traded similar premium, similar spreads on the same day, because these are all weekly expiries. You can compare every Monday to all the Mondays that you've traded before that. So some people say, okay, why do you trade for, as a thing for this? They say, why do you trade Fridays and Mondays? Because actually, if I pull out my entire history, I'm profitable for Fridays and Mondays. That's why I continue to trade Fridays and Mondays, even though sometimes the risk reward is not great. But if it is on the worst end, like for example, today there was no way I was going to enter a trade after morning premiums, then I'm going to skip it anyway. That is where discretion also comes into. It's not 100. What I do is not 100% systematic, right? So that experience does give you a lot of advantage, and there's no other alternative to it. If you have seen the same prices of similarly spaced options over a long enough time, you will get a good feel for it. Now, how do you do that initially? Trade smaller sizes, trade all different kinds of spreads, trade at the money, trade 100 points out, trade 200 points out, see how it's behaving. So, yeah.
Right. Shreyas, we'll take the last two questions, and as we are we're near about 10:50, so we'll take last two questions. Naresh, why don't you go ahead?
Hey, hi guys. Hi Shreyas, big fan of yours. I have watched your video on Elon Markets. From before that, I have been watching your videos, daily journals and all. So, Shreyas, I have two questions here. So the first question is how good, how difficult, or how easy it has become to earn money from the market. When you compare it with 2018, 2019, I think you are trading from 2017 around, right? So how
Yeah.
easy or difficult it has become to earn in this market scenario? How different it has become? The second question is, so whenever you are taking a strategy, so what is the thing you look at? You go into the Greeks and all, or is there any simple thing like, okay, this much 20 rupees I have to sell if it is Monday, 30 I have to sell if it is any other day. Is there anything like that? Because I don't have any enough knowledge on the Greeks, so I wanted to see if there is any simple trick that would work for me. These are the two questions, Trace.
Yeah.
Thanks a lot.
Yeah, no problem. What was your first question again? I'm sorry, I think I missed the second part of that. The first question.
Sorry. So I was asking how difficult or easy it has become to
Right.
earn money
Got
from the
it,
market
got it.
compared
Yeah.
to
Yeah, got it. So to be very frank, I would say it is neither become more difficult nor become less difficult. Like it's very the last 2 months for me have been very frustrating, but it varies within a year itself. There are periods that work out really well and some not so much. I would say 2018-19 more or less positional trading wasn't so hard because we were stuck in quite a tight range that period. Now I'd say positional trading is definitely not something that I would prefer. So there are periods within a certain, as long as you're an intraday trader, you will have certain months which are working out. No matter what you do, you're making money, and certain periods where no matter what you do, you're losing money. So I don't think it's worth spending time to analyze how exactly harder or easier it has become. I would say personally, if you're not, look, if you're losing a lot of money in this particular period, I'm sure there's a trader who's making a lot of money in this particular period. So is it working out well for you? Are you finding it difficult? If you're finding it difficult, you have to take appropriate actions and reduce your risk exposure if you're losing money in a certain kind of market until things settle down and become more favorable to you. Now, second, in terms of do I have to sell exactly this premium? I don't think I have a set rule for all volatility environments. The only thing that is set is that, okay, in different volatility environments, my risk appetite will vary. Because if I have too small a risk appetite in a highly volatile environment, it's kind of I'm shooting myself in the foot because I know for a fact I'll get stopped out. If I have the same risk reward definition for the current market that I did for, let us say, the market from December, then I it will not work. So what changes is depending on the current nature of volatility. In a higher volatility environment, my risk appetite also on a point basis will go up. Whereas on my portfolio level, by managing my position size, I'll try to keep it the same in terms of percentage. If that makes sense. No, there's no such rule that, okay, Monday I'm going to send 20 rupees option or Tuesday I'm going to send. Sometimes it also depends on how much of a premium fall off there has been, once again, overnight. So, yeah, there's no set hard and fast rule as to this is how much premium I want to sell.
Yeah, absolutely. Yes. Last question from Systematic Quants.
Yeah. Thank you, Gordon. Thank you, Shreyas. You've been great, actually, Shreyas. I have only two questions. One, Shreyas, I was wondering how you keep the stop loss. You keep on selling, coming closer, going away, and still you're able to manage that 5 points, which I always look your videos at, but I could not guess how it is like. And is there any percentage stop loss and secondly, I've seen you're not putting stop loss in the system also. Probably I may be wrong, but I would like the answer. The second question is, how do you trade expiries? Because in expiries, the premiums are very low on Nifty and the jump is very high. So still you are making money. Thank you.
Yeah, hi. Thank you so much for your question. So, so as far as stop loss is concerned, my generally how it works is, let's say I'm targeting for a particular day, I'm targeting 10 to 15 points. So my mark-to-market stop loss exit will not be more than maximum of 8 to 10 points. That is how much I'm willing to risk. If I lose that, I'll try to manage the trade to not lose that until I lose that much. If I lose that much, then I'm done. My day is over because like my risk appetite is met, right? That's where my whole edge comes from, is that I'm taking an exit when I've lost how much I was willing to lose. Now, in case I'm in a profit, now let's say between morning till 12 o'clock, I'm making a good profit. Now, it would be stupid for me to give up that entire profit by the close. So then I will have a trailing stop loss. Now, if I know that for example, previously my trailing stop loss used to be 2 points. Even when VIX was like closer to 20, it used to be 2 points. Now that trailing stop loss in the second half, it starts off somewhere near 5 points of a trailing stop loss, then gets reduced to 3 and then 2. And then I just decide to take an exit whenever there's a dip in IV. It accordingly, even if I get stopped out then in the second half, assuming I've made some profit till then, I will lock that in. So that is my current approach. As far as expiries, premiums jumping, look, the idea is for premiums to jump, they need to break certain levels to jump. Like, for example, if there is a previous swing, now let's say you're short a put option, there is a previous swing and then a swing that is lower than that, and you are trading below 2 swings on the upper side, it has to break those levels to go up. And generally, my exit on a particular strike will be around that swing. So any short covering, any breakout that has to come has to cross that level. Now, generally my whole thing is I will be exiting just at the point where someone who's a momentum trader will be trying to enter for that breakout, which is why I'm able to get out. Like, for example, last week I exited the 16500 put by the time it was 14. Of course, then the lower level puts also spiked, but eventually that put made a high of 85. It made a high of 85, exited at 14. So there's no way that, unless you have see, last week was something else altogether. The gamma move was huge. And that's why, there are days where you'll not make money on expiry. That was a break-even close for me, even though I was in profit in the first half. It happens. Those are all part and parcel of expiries. But most of the time, the idea is before the risk comes onto a particular strike, I will try to exit from that strike. Why don't I keep the stop loss in the system? Because the risk of misexecution is huge for me. If I'm trading, let's say 20,000 size on Nifty, I've had many times random price execution simply because my system stop loss got triggered and liquidity was not there. I got some, huge slippage. There are times I've got 20, 30 point slippage on big sizing, and that loss is huge. So instead, I would always prefer to manually place my orders and exit. Even if that means that it'll be a little delayed. Now, I can do this because I've never had a freeze. I've never frozen in front of my desk to place an order. There are some people who, it happens wherein, you're losing money and you're just staring at the screen and it keeps going. If you're that kind of person, you absolutely have to have a system stop loss. For me, it's an operational problem. In case I get, tremendous slippage on a large position size, that itself will cause me more harm than anything else. There is a day where I got 10 lakh slippage in a trade. Because, I placed an order at something like 50, it got executed at 80, and that's it. It's gone. I can't do anything about it. Next second, it's trading below 50. It happens. What can you do? So that's why I avoid system stop losses. But if somebody is new and you're not really having a massive quantity, I think system stop losses work perfectly fine.
Fantastic, Shreyas. So, Shreyas, great. I mean, this has been an awesome session, and even now there are some like 25 people still wanting to ask questions, and we can go on till tomorrow's pre-open if we continue. So, unfortunately, I will have to end this session. But before that, I'd again like to thank you, Shreyas, for opening your heart out and giving your insights in such a honest and transparent way. So thank you very much. And again, thank you everyone for joining in and asking your questions enthusiastically. I'm sorry I couldn't take all the questions, but unfortunately we have a time limitation. So thanks again, and all of you have a great trading week ahead, and hope you all make a lot of money.